Let's take stock of the markets yesterday, and we wrapped up the day with a positive momentum. The 19,500 mark was maintained, and we shut sharp at the highest point of the trading day. And good to know that the broader markets as well did manage to eke out a gain that was higher than what the frontline indices clocked in. And it was IT all the way, but you had a rally that percolated all the way to the rate sensitives. So the PSUs put up a great show, particularly those railway stocks. And the rally within the metals basket as well was intact. So if we're taking the move that we've witnessed off the life highs, then for the Nifty, it's about 2.3%, Nikunj, of those levels.
So Avan, after this giant range-bound patch for the market, are we getting ready for a breakout trade, or are we getting ready for a trending move? The trending move in railways, defense, mid and small cap stocks, that never got challenged. We're talking about a trending move purely from the prism of what benchmark indices have done. What drives the market in the short term? It is the risk-on environment, which I think globally is very important. So globally, the risk-on environment is intact. Nasdaq, price appreciation in Bitcoin, US tech stocks, emerging market equities, gold is not catching up, VIX is under control. So the construct of the market is that the bulls do have an edge because the risk-on environment is up. Second, you look at flows, patchy but positive. They may not be this time moving into individual stocks which are listed on the bourses, but they are moving into block deals. So the flows, because they are moving into individual stocks and not so much on Nifty 50 stocks, the flow is not really getting captured in the way how ordinarily it should have got when historical FI flows are moved into banks and FI dominated sector. And third, I guess, is the macro positioning. And the macro positioning, again, you can argue that, okay, material and crude prices have started going up. But in the first wave, when every time commodity inflation comes back, it will actually always support global denominated sector. And that is what we've seen in terms of metals and the price appreciation, what we've seen in, let's say, material stocks. So I will not be surprised that a giant range-bound patch of the market finally moves into a trending move for the index.
Yeah, that trending move for the index is what we are witnessing. I think perhaps yesterday was the first day of that massive breakout that we saw. But the thing you talked about, the global risk on, which is quite visible in metals, is also visible in the IT pack. Because believe it or not, it does get a rub-off impact. It's very different from the, the FANG stocks per se of NASDAQ. But nonetheless, it does drive to the cues of what's happening globally as well. And over the last 1 month, we have seen a massive outperformance in Nifty IT and as compared to the other banking names. And there has been that classic, inverse kind of relationship. When banks go higher, IT underperform, but right now is the phase when IT is outperforming and Bank Nifty is underperforming. Those moves are there for you on the screen. Of course, for the year, we have seen the likes of SBI, HDFC Bank, they've all underperformed with a negative kind of trend Y3 basis, but it's the mid-cap IT, Nikunj, which has been roaring away, persistent sitting at life high, KPIT, Cyient, in a market where macros are weak, they are sitting at life high levels.
So Nisha, we are using this phrase that for banks, there's nothing which could go right, and for IT, there was nothing which else could go wrong. And that same phase has actually translated into what really could be called as a market action. Banks were priced to perfection. And since banks were priced to perfection, even though numbers have been strong, everybody loves it, but everybody owns it. You may love something, but you also own something, well, then the price appreciation is not going to be jumbo in the short term. IT, the reverse. Whatever could go wrong actually has gone wrong. And the positioning was low and the positioning was weak. I mean, folks like Samir Rav loved IT for years. I mean, when he came to a studio last week, he said, I don't like IT. I'm staying away. There are better stocks which I want to buy. So that's a old IT bull who's telling you that he's not buying into IT. But you must understand that bank versus IT, you cannot write off banks and you cannot ignore IT. My limited point is that why last 2 or 3 weeks we've been talking about IT is not just based on price action, but it is based on macro action. IT pockets can be divided into 2 parts, or IT business in India can be divided in 2 parts. The traditional bread and butter business, which is where Indian IT companies have excelled, and then there is a disruptive wave which is coming from the AI quadrant. We don't know the impact of AI quadrant. Surely it will have an impact on the future business. But the bread and butter business, which had slowed down because of war in Europe, because of delay in decision making, because of US banks and the regional crisis there, that has stabilized. The US economic data is looking strong and impressive. So that also is acting as a tailwind for the IT. So markets are saying that, okay, there's a disruption happening to wait, there is disruption waiting to happen, but that is something which will keep the P multiples compressed. But there's a growth revival which also is happening, which is something we can't ignore. So from bombed out pockets, I think some of these stocks are coming back. I think my view on IT is simple. This is the traditional business is a low growth business. When you are staring at a 6.5% GDP and a nominal GDP of about 10-11% and an average earnings growth of about 14 to 15%, you're ain't going to get an IT. Which means within IT, you move into specialist or you get into product-based companies. Look at RateGain, 100% up this year. Look at MapMyIndia, how much it has gone up. I think that is where the puck has moved. So IT, I think you should be trading in IT. The deep swell, I think, is not done in terms of a comeback right now. But beyond that, to make an assumption that a new bull market in large cap IT is going to start, I think it'll be too naive. That's my sense.
Okay, maybe specialized IT is a pocket as well to look at. But that aside, and we never tire of talking about the stocks that have been chugging along. Yes, you guessed it right. It's those railway stocks. Phenomenal is perhaps the only word to use to describe the kind of returns that we've seen over the last 6 months. Take a look at it because the numbers really speak for themselves. But then at the same time, let's also take in account to another metric, and that is the overall valuation picture. And take a look at the likes of Atitagarh and RVNL, all of them trading at very high valuations as compared to the historical average, Nikunj.
No, look, railways, nobody expected railway stocks to give returns and perform the way they have performed. And everybody has gone wrong in acknowledging that how when the market euphoria takes over, in the short term, markets can remain overextended. Why are we revisiting these railway stocks? Look, Avan, Aisha, I don't know what the right valuation is. Nobody knows what the right valuation is. I could argue back and say that, okay, Asian Paint should have not traded at a P multiple of 100 and DMart should have not traded at a P multiple of 120 and Trent should not trade at a P multiple of 120. But markets, there is, like the great Rakhi Jindwala used to say that there is no professor who has ever said that this is the right P multiple, that is the right P multiple. Optically, I can say that trailing P multiples of 70 times for Titagarh, 20 times plus for all the railway stocks are unlikely to sustain. But the second factor which always tells you that where the excitement and euphoria is moving is that you look at the volumes. And Sumit gave me a data which is that IRFC yesterday has traded 50 crore shares. That's nearly 30% of the free float. And I've seen this entire cycle play out in the past where mid-tier PSU banks, a lot of power stocks, they start trading almost 50% of their free float. Now, the government ownership in some of the railway stocks is very high and the free float is low. And the free float is largely dominated by HNI and by retail folks. And that is where a lot of intraday churn seems to be happening now because the price action is so tempting for anybody to ignore it. So why are we discussing railway stocks? Well, all we are trying to say is that there is something called risk-reward ratio in the market. If you own them, well, good luck, you may continue to own them. Because these stocks may extend more before they peak out. But if you plan to buy them, and if you're especially buying them on intraday basis, then you just got to watch your steps. So it's like a statue. It's like, I'm not writing any prophecy here, but all I'm saying is that sometimes in market you got to watch your steps. Maybe with some of these stocks, when you see this kind of data in terms of participation, you got to say yourself, you watch your steps. I'm purely speaking out of experience. When these things happened, the end game is very bad.
Yeah, the momentum is definitely very strong, but it's whether you want to ride the momentum and what kind of risk reward you're looking for is what you need to watch out for. But Nikunj, it's not just the railway stocks, right? If you look at the other mid-cap, small-cap names, a lot of stocks have actually doubled in 2023. In fact, if you look at the stocks which are sub 1,000 crore market cap, almost 244 stocks have doubled in 2023 already. Even if you look at the over 10,000 crore market cap, and these are your, large mid-caps and large cap category, 23 stocks have managed to double in this year so far. There are a lot of stocks, of course, which have become expensive now, which are trading at valuations of over 100 times. Look at a PTC Industries. It's trading at a trailing multiple of 303 times. I don't know if there's any stock which is traded at that multiple. Of course, there's smaller companies like Genus Power, Electra Green Tech, Zentech, JBM Auto, Jupiter Wagons, etc. But a lot of these companies, Nikunj, now are trading at over 100 multiple, and I think this is what you're saying, that you need to be very, very cautious of your step going forward.
Since stocks which we identified, all of them have 2 or 3 things in common. Either they're defense, or they are with railways, or they represent EV. And that's where I think the puck really has moved in terms of an excitement. I go back to that same limited point, and we are looking at trading P multiples, trailing, and the future growth, even if it is, future growth is going to be 100% on a CAGR return for next 2 or 3 years. At these levels, if you've really invested in some of these stocks, the future return gets compromised. Market history, whatever I've read, whatever I've understood, whatever I've learned from market gurus, they tell me that the buying price will always be the determining factor of how the future returns are. And from some of these levels, not everything will go down, but lot of these stocks which are there on your screen may just not give you the kind of returns what you've seen in the past. All I'm trying to say is that there is something called recency bias which is there in the market. Recency bias is that what has happened in the past recently will happen in the future. That human nature is that we suffer with recency bias, whether it is life or whether it is markets or whether it is relationships. But the recency bias also tells you, and the market history also tells you, that when you bought stocks at these levels of 100, 200, 300, the future return will always get compromised. That's my limited point.